Ethereum did not lead the market this week because speculation returned. It led because capital returned. ETF demand strengthened, inflation cooled, treasury yields declined. A major holder moved ETH away from Coinbase Prime, and traditional finance expanded access. Today is July 21st, and Ethereum just delivered its strongest structural recovery in months. This week's Ethereum story came down to four forces. Price reclaimed key structure, ETF demand accelerated, institutional distribution expanded, and tokenized finance moved deeper into production. Ethereum's momentum came from flows, infrastructure, and capital allocation. Ethereum outperformed Bitcoin across the week and reclaimed leadership among the major crypto assets. ETH began the period below 1800 before cooler inflation data changed the structure. CPI declined 0.4% in June. PPI declined 0.3. Treasury yields moved lower as inflation pressure eased, reopening the risk window across financial markets. Ethereum responded immediately. Price reclaimed 1800, pushed through 1900, and established a trading range between 1880 and 1920. Earlier attempts to establish 1800 as support had failed. This time, the level held. The ETH to Bitcoin ratio confirmed the rotation. It climbed from approximately 0.0285 Bitcoin per ETH at the beginning of the period to roughly 0.029 by July 20th. That represented a relative gain of approximately 2% against Bitcoin. The move also developed across multiple trading sessions instead of disappearing after the initial CPI reaction. Price advanced, the reclaim level held, relative strength remained intact. On-chain positioning reinforced the move. Ethereum stake climbed to approximately 33.5% of the circulating supply, locking more than 40 million ETH inside the network's consensus layer. More capital entered through ETFs, while more ETH remained committed to staking. Demand strengthened as available supply tightened. That was the first structural signal of the week. Ethereum's price action began aligning with its capital flows. Flows were the strongest part of the Ethereum story. Spot Ethereum ETFs recorded approximately $105 million in net inflows from July 13th through July 17th. This marked a second consecutive positive week following an 8-week outflow streak. BlackRock's ETHI did the heavy lifting. The fund absorbed more than $135 million across the week, overwhelming outflows elsewhere in the category, and concentrating demand behind the largest Ethereum ETF. Capital did not simply return, it consolidated. On-chain positioning reinforced the flow data. One newly created wallet withdrew 30,100 ETH from Coinbase Prime, moving more than $52 million in Ethereum away from a major institutional trading venue. The identity of that holder remains unknown. The movement of capital does not. A major block of ETH left Coinbase Prime and entered a newly created wallet. At the same time, staking continued locking supply inside Ethereum's consensus layer. ETF demand increased. Staked supply reached a record. A major holder moved ETH away from a trading venue. That's the positioning signal. The market was not expanding available ETH, but it was absorbing it. This is what separates a capital-driven recovery from a speculative bounce. Price moved higher because demand strengthened while more supply moved out of the active circulation. Traditional finance expanded Ethereum access. Morgan Stanley completed the rollout of spot crypto trading through E-Trade, bringing Ethereum alongside Bitcoin and Solana onto one of the largest brokerage platforms in the United States. Eligible customers can now buy, sell, and hold ETH through the E-Trade platform using infrastructure provided by Zero Hash. This is not institutional accumulation. It is institutional distribution, and distribution matters. Every major brokerage platform that adds direct Ethereum access reduces friction between traditional capital and digital assets. Ethereum moved one step closer to become a standard financial product inside a traditional investment account. The tokenization story advanced at the same time. Tokenized US equities continued expanding across Ethereum's ecosystem. Custodially backed tokens connected to companies like Apple, Tesla, Nvidia, and hundreds of other popular publicly traded securities are now available through regulated issuers and on-chain financial platforms. These products are built to track the economic performance of underlying securities held through traditional custody structures. They are not synthetic perpetual contracts. They connect blockchain-based markets to real financial assets. Ethereum remains central to that transition. Ethereum provides the settlement foundation. Regulated issuers provide the assets. On-chain platforms provide distribution and liquidity. Layer 2 networks provide scale. Base, Coinbase's Ethereum Layer 2, is positioning itself as infrastructure for tokenized global markets, including equities, commodities, spot markets, and other major asset classes. This is how financial infrastructure moves into production. The Ethereum ecosystem also expanded its institutional privacy capabilities. The team behind the Ethereum Foundation's Institutional Privacy Task Force launched ETH System as an independent company focused on privacy, protocol design, compliance, and commercial execution. Its backers include Joe Lubin, Bitmine, SharpLink, and other Ethereum ecosystem participants. The mission is direct: build confidential systems that allow banks, asset managers, and regulated institutions to transact on Ethereum without exposing sensitive client information or transaction details. All of these developments point in the same direction. Ethereum is being wired into traditional finance as infrastructure, not as a speculative side bet. Sentiment changed because the underlying data changed. Ethereum gained more than 6% following the CPI release and established relative strength against Bitcoin. But price was not the only signal. ETF flows turned positive, staking reached a record. Traditional brokerage access expanded. Tokenized markets moved deeper into production. Institutional privacy infrastructure advanced. These developments changed the narrative because they changed the structure underneath it. For months, Ethereum traded under the weight of weak fund flows, institutional hesitation, and questions about its position inside the broader crypto cycle. This week broke that pattern. The market stopped treating Ethereum as the asset being left behind. It started treating Ethereum as the asset capital was rotating back into. That shift matters because sentiment follows positioning. Capital moves first, narratives follow. This week, the capital moved. Ethereum now has 3 continuation signals: positive ETF demand, a sustained hold above 1800, and a decisive move through 2100. The first signal is active. ETF flows have remained positive for 2 consecutive weeks, with BlackRock leading demand. That demand must continue. If ETF's flows turn negative again, the recovery loses its primary source of capital support. The second signal is holding. Ethereum reclaimed 1800 and converted the level back into structural support. A loss of 1800 breaks the current structure and returns ETH to its previous consolidation range. The third signal is confirmation. 2100 is the level that converts recovery into expansion. A decisive break through 2100 establishes a higher trading range and opens the next phase of Ethereum's recovery. These are the levels and these are the signals. The broader forces remained aligned. ETF demand is absorbing supply. Staking is removing ETH from active circulation. Traditional finance is expanding distribution. Tokenized assets are creating new demand for Ethereum-based financial infrastructure. Institutional privacy systems are moving into commercial development. The conclusion is clear. Ethereum has moved from an outflow pressure into a capital-driven recovery. This move is not being built through hype, but it is being built through fund flows, locked supply, expanding distribution, and financial infrastructure. 1800 protects the structure, 2100 confirms the expansion, and ETF demand powers that move. Now, reading a week like this requires more than following the price chart. You need to understand how market structure, capital flows, liquidity, positioning, and sentiment connect, which is exactly why I wrote Understanding Crypto, a clear guide for new investors. The book gives you a clear framework for separating signal from noise and understanding why markets move before the narrative becomes consensus. Of course, I'll put a link in the description for you. And subscribe to CoinOps for full market breakdowns, institutional analysis, and the signals shaping crypto before they become consensus. Then tell me what stood out to you this week. ETF demand, Ethereum reclaiming 1800, tokenized equities, or the push towards 2100. Your perspective helps shape what I cover next, so stay locked.